Macro strategist at Vanda Research. Viraj, let's come back to foreign exchange because this is where we are seeing some compelling trades, give or take a few percentage points. We've been just hovering around this parity mark now in euro dollar. What do you make of the chances of intervention by the ECB at some point?
Unfortunately, the ECB are probably a price taker right now when it comes to the euro, especially given that what's driving the euro is really a structural balance of payment shock that the central bank can do very little about. Now, I fully agree that the ECB, the window for the ECB hiking rates meaningfully is closing pretty quickly, with the sort of warning signs around a recession flashing yellow, if not red already. And I think the sensible path for the ECB is to front load these hikes. Almost capitulate, go 50 in July, go 50 in September, and then to say, look, we really don't know where the market goes after that. And so, this is almost a dream environment for perma euro bears, where they know central banks and policymakers are almost in a political and policy impasse scenario. And I think, this is a really struggling environment. But, that being said, parity was our initial landing mark when the war started out in Ukraine. And I think to get another 5 to 10% depreciation here, there's a lot of bad news already priced in. We need to see the narrative turn even worse from here. Not a scenario we can rule out, but certainly, a lot of bad news already now in the price.
Viraj, you use the term capitulation. One of our other commentators said overshoot yesterday. And these sort of words come together. It reminds me of other situations we've seen on markets where there's a one-way trade until suddenly it stops and snaps back the other direction. We've had two moves by other central banks today, yet it's had no bearing on the dollar trade at this point. So it does beg the question whether we've got something around the corner where investors will change their tune on this dollar strength.
Yeah, our view hasn't been that this is a market driven by policy. It's driven more by sort of relative cycles. This is an FX market driven by growth differentials. We've just been characterizing euro-dollar or even cable and pretty much the dollar against anything as a first into recession play. So with Europe on the brink of a crisis, naturally, given on paper the risks are much severe, the data has been collapsing much faster. It's natural that the dollar is finding a bid here. And then if you take the other side of the equation, are the Fed, are the Treasury ever going to step in the way of a strong dollar in this particular environment with inflation at 40-year highs? The answer is no. This is almost the perfect playbook for them, where the dollar is doing a lot of the tightening efforts for policymakers without the need to raise rates rapidly. So, I think it's a really challenging environment for FX markets, of different ones to what we're used to pre-COVID or even after the GFC. And I think this is really a strong dollar world for the short term.